Hi, welcome to the Generate Investment Update. I'm Stephanie, a Generate advisor here, and I'm here with Warwick Simons from Compound Global, one of the advisors to Generate. Welcome, Warwick.
Great, thanks, Steph, for having me. It's good to be here.
Pleasure to have you here. So it's been a volatile market this month. What's your perspective on what's been happening?
Yeah, I'd say everything's been happening. It's been a, frankly, mad 2 or 3 months in the last couple of periods, from, I'd say, late February through March, leading up to President Trump's Liberation Day on April 2nd, and then the last sort of month or so since then. I think what's really been happening here is it's a whole series of phases. So in March, there was suddenly increasing awareness within global markets that something was afoot with the tariff plan, and that potentially it's not as constructive for US equity markets and the US economy as people had thought through the January and February period. So markets pulled back a little bit into early April. But on April 2nd, when President Trump announced his tariff plan, I think the markets were shocked with how aggressive he was going with his plans to restructure world trade and the implications for the world economy and for the equity markets and companies that were invested in. So what happened is, after the announcement on April 2nd, we had a very sharp sell-off of, I think it was 10 to 12% over the next week or so. And then there was a lot of concern that nobody really knew what President Trump's plans were and how that affected them. And that was applied whether people were in the US or companies were in the US or in Europe or in Asia or in New Zealand and Australia. So there was a lot of uncertainty. I even, in conversations with a friend in Europe who manages some capital there, he was saying, look, people aren't sure if President Trump is destroying America, right? So that was a level of the sentiment and fear going around markets in early April. And I think the thing that changed that was the announcement, I think it was April 9th, it was about a week later, that the tariffs would be delayed by 90 days for most countries. And I think what that did is that removed some of the worst case scenarios from the market, this whole President Trump is destroying America. And it gave pretty strong indications that this was just a big negotiation, right? It's the art of the deal. Yeah, it's an extreme way of negotiating, right? Come out with this very, very aggressive ask and then see where things pan out from there. So since that point, markets have recovered. Here we are in early May. We are roughly around the level we were early April. So that's constructive, that's good. There's been a lot going on, but overall I think we're hopefully moving forward to a more constructive period. We're probably going to have more volatility, but I think the key thing is that we're thinking about for our investments is we own good businesses. These businesses have great products, they're very well run, they're very profitable, they've got a lot of growth opportunities. They can manage through this volatility. And so by owning good businesses, we're pretty confident that 6, 12, 24 months from now, those businesses will be in a good place.
So what does this mean?
We're going to have this volatility, and we're very happy owning these really, really good, high quality businesses because they can navigate through that volatility. I think we are going to have a lot more headlines on the trade front over, for the rest of this year and for next year. And we're just concentrating on trying to own, the businesses that will do okay in that environment. We have made a few changes in the portfolio, pulling back from some businesses that would be more affected if they're selling a lot of goods that are produced in China, for example, especially selling those into the US. We've pulled back from our investments in those areas because with the sell-off, there's a lot of opportunity in other areas. And so what we've been trying to do is on a relatively small scale, but reorient the portfolio towards companies that we have more confidence and conviction in over their prospects over the next year or two, rather than ones where the outlook is a little bit more uncertain.
Can you give us a few examples?
One business that we've had in the portfolios for a long time, and everyone knows it, is Meta. Okay, so Meta is it's a whole collection of apps. Obviously Facebook, Instagram, it's WhatsApp. Those are the 3 main properties that Meta owns. They are impacted by tariffs because the advertising business of Meta, a lot of it is small and medium businesses that source their products from China and then sell to consumers in New Zealand, the United States, and elsewhere. And advertising is somewhat cyclical. Okay, so there is a negative effect of the tariffs for their business, but there's 2 enormously positive effects for their business as well. Number one is Meta is the best source of advertising for all of those companies, and they are likely to increase their advertising share on a business like Meta, which is the best source of advertising, and reduce it on other properties, other social media sites or general web advertising. So that's constructive for Meta over a period of time. They're likely to gain share over this period. And the other thing that's happening with Meta is their huge investments in AI, and those are paying off. At the earnings call, which was about 10 days ago, they increased their guidance for CapEx, capital expenditure, for the next 12 months, basically saying what is working with AI is working very well, and they're very, very constructive and very, very happy with that. And the AI-driven gains for Meta come in a variety of areas. First off, it makes the content on the platform more interesting, right? So it's better at saying, okay, Steph, for you, through their algorithms, this is the type of content you like, we'll show you more of that. And so hopefully you enjoy spending time on the platform, or you spend more time on the platform. At their earnings release, the number of users on Meta properties, so Facebook, Instagram, WhatsApp, increased 5% year on year. So everyone thinks these things are saturated. They're still growing at 5% year on year. So better content is one. Second one is a much better ads recommendation engine. So the ads are more effective. And third, you've got potential growth opportunities in WhatsApp with business messaging and all of their other AI initiatives, whether it's the Meta AI app or the Ray-Ban smart glasses. So we look at a company like Meta and we're like, well, yes, there is a net negative, but the stock price is much cheaper. And there's all these other positives. And so we've been increasing our positions in a company like that, okay? And then let's change tack and have another example, something like InPost, which is an e-commerce delivery company in Europe. Most of their business is in Poland. They have out-of-home lockers that, if you catch a train to work, you can pick up your, package on the way home from work, or you walk down to the corner store and there's an InPost locker there. Their Polish business is fantastic. It's very profitable. They're the clear market leader. And they're building similar businesses in both the UK and France. And 2 weeks ago, they announced an acquisition that's going to materially improve the prospects of the UK business. So that's another business that is not affected by the tariffs at all. It's in Europe, not the US. And it is incrementally got better over the last couple of months, but the share price has sold off quite a lot this year. So it's another one that we're adding to. So it's the idea is we don't totally change the portfolio, but on the margins, we'll reduce businesses that might have more exposure to products sourced from China and increase to businesses like the Meta and the InPost of the world.
So Warwick, you live in the US. Has much changed in daily life as a result of these changes?
Mercifully, not a lot has changed. Most of our friends, people are still doing their job, trying to do the best they can, look after their family, do some fun things on the weekend. All of that stuff is the same as it was 6 months ago, 12 months ago. There's no real change there. That's the good news. I do fear that there might be some material changes coming in certain aspects. If you look at the short-term data on the amount of goods being shipped from China to the US, or the activity in the ports where they're producing these, or trucking activity, we can see that there are some indicators that there's going to be some shortages for some goods, right? So most things, food will be fine because that's all sourced locally. But if you want to buy a pair of shoes that's normally $150, you might find that they're not available, or they're $250, right? So I think that will change people's behavior a little bit. And that's part of the reason why I'm reasonably constructive on equity markets here, because those are the lack of availability of a new pair of shoes or any other goods from China is a net negative for most consumers. Most consumers be like, why is this more expensive, right? And inflation was one of the critical issues in the election in the US 6-9 months ago. And so if there is inflation or lack of goods, that will put pressure on President Trump. It will put pressure on members of his Republican Party to do something about it. And this is part of the pressure that I think will ultimately cause the Trump administration to moderate their position on tariffs, right? In early April, it was markets selling off, both the equity market and the bond market. Probably in the next few weeks or next few months, it'll be lack of goods availability because of the tariffs. And I think all of that disruption will ultimately lead to pressure sort of leaking through and being brought to the administration to say, maybe it's time to moderate. And then that, again, takes the worst scenarios off the table. And I think with that, it makes us reasonably constructive for most companies. Again, there'll be some that might have some difficulty, but most of the companies think we're reasonably constructive over the next sort of 6 to 12 months.
So it is nice to hear the confidence you have in it. Thank you, Warwick. Thanks for being here.
Great. Thanks, Steph.
Thanks for watching.